Today I'm speaking with Dan Rasmussen. He's the founder and portfolio manager at Verdad. Verdad runs capital with rules-based ideas, and they have a big focus on levered small cap value stocks. He publishes tons of research across many different interesting topics. And today we're going to talk about his new book, The Humble Investor, which summarizes a lot of these ideas that he's been publishing with for a wider audience. And I thought it was a great book. Highly recommend it. I think it's an investing classic. So welcome to the
Thank
podcast,
you.
Dan.
Well, that's a nice review. So thank you.
Absolutely. Yeah, it's a great book. So how'd you first get the bug? How'd you first get interested in investing?
I wasn't the type of person that's been buying stocks since I was 10 years old or something like that. I had to get a job out of college and I was trying to think of what I wanted to do. And what I liked about, I was actually a history and literature major. So I've always loved history. And what got me into investing is the idea that really all you have, in investing, you're betting on your ideas. And the only way to really test your ideas is to analyze the past and to try to learn its lessons to make good decisions about the future, right? Even when you're right building a model, right? You take historical financials and then you project them into the future. And that's true in almost every exercise you do across finance. And so I thought, well, this is sort of a way to be an applied historian. I won't just like sit around writing useless stuff that about a time that's gone by. I'll take action based on learning from history. And that was what really got me excited about it. And that's what I've been, focused on since. And so a lot of my research and a lot of the research in the book is really built around, analyzing historical financial data to try to discern lessons about what we should do in the future.
Awesome. Yeah, it's definitely something where you can apply lessons from history. I think investing is a field where you can really do that in a really interesting way. So awesome. So in the book, you talk about your journey and how you began learning about finance and economics by reading a lot of the literature, a lot of the books. And you said that it pushed you towards radical skepticism. So how would you describe that process towards radical skepticism?
Yeah, so I bucket that in two ways. I think one is sort of the traditional way of being a radical skeptic in markets, which is to read a bunch of Eugene Fama's work and start thinking about what efficient markets hypothesis really means. And I think EMH is one of those super powerful theories that you have to deal with and you have to always have at the forefront of your mind. I like to say one of my sort of favorite mottos in investing is that investing is not a game of analysis, it's a game of meta-analysis. It's not what you think, it's what you think relative to what the market thinks. And I think there's a lot of first order thinking that investors take on, right? They say, oh, I've just completed my analysis of the stock. They say, well, but if everyone else had the same analysis, even if your analysis is right, you can't make any money from it, right? You've got to take into account the market. And there's a wonderful paper by a colleague of mine, Sam Hansen, who wrote about Greek shipping companies. And this is a story that's in the book. And what's really interesting with these Greek shipping companies is when times are good and shipping prices are high, all the shipping companies run this analysis. They say, well, current shipping rates, I'd make X amount of money and it cost me Y to build a ship. And so right now the IRR on building a ship is like 25%. So I should go commission a new ship. So they call up the Korean shipyards and they, start the building of a new ship. And it takes 2 or 3 years to build. And then 2 or 3 years later, the ship arrives. And sort of by coincidence, they're shocked to find that shipping prices are much lower than they were when they commissioned the ship. And it turns out that the reason that shipping prices are lower is that all of their competitors commissioned ships at the exact same time because they did the same math and they thought, oh, gee, ships are making a lot of money right now and it costs X to build a ship. So the IRR in shipbuilding is very high. Let's build. And they call this competition neglect. And I think it's a wonderful term. And it describes, I think, a lot of the problems with first order thinking and investing is there's competition neglect, right? You've done your great analysis, but you've neglected to think that other people are probably doing the same analysis. So that's the first level of radical skepticism, which is know your competition, understand efficient markets and its implications. The second level of my skepticism is around predicting the future. And there's a lot of, probably when I was just getting out of college, it was new then, probably not new now, but work on forecasting. Philip Tetlock is sort of the big name here. And Philip Tetlock did these big studies of experts, and he found that experts are no better than non-experts at making predictions in their field. And in fact, they're often not even better than random chance. And when you look at how to make a good forecast, right? So you say like all the people like who are out there being like, I'm a Russia expert and here's what I think is going to happen in Russia, or I'm an oil expert and here, basically Tetlock's work shows that these people are not, their predictions are sort of meaningless and worthless. They're not accurate. They're not useful. They're no better than some, no, than chance oftentimes. And what tends to actually work the best, and I sort of love this, given my historical lens, is this idea of base rates, where you say, let's take all of the analogous situations historically and basically take the probabilities. So if I'm predicting, for example, that the US is going to war next year, one way of thinking about base rates would be to take, well, how many years has the United States existed? And how many of those was it not at war? And of the years in which it was not at war, how many of those years did it go to war? Right? And then you'd come up with a number and say, oh, okay, it's a 4% chance, right? Whereas if you think about it sort of subjectively, you think, oh, China could invade Taiwan, or Russia could do this, and therefore the probability is 32%, right? And you'd be neglecting base rates. So I think it's my radical skepticism is around both around markets and around forecasting, and investing is forecasting. So it's around our own abilities and a focus on not neglecting competition, not neglecting base rates, but rather incorporating them into our investing decisions.
Yeah, I've had a very similar experience. When I first started investing, I took a lot of gurus very seriously. And as time goes by, you realize that practically all of their predictions don't come true or they're wrong in some way. You follow a lot of like stock analysts that you think are extremely talented and know more than everybody else. And then you actually follow their picks and they don't know any more than anybody else. You follow a lot of big investors. Often you can explain their returns by their factor exposure. So yeah, it's definitely a field where that really rings true. Like a lot of what Tetlock is talking about, where like simple predictive models tend to outperform the best experts and gurus that you'll come across.
Yeah, and it's also sort of interesting. I started out doing, fundamental investing and building models. And there was sort of this moment of, I think a lot of junior people have this sort of realization. There's a famous story about Ken Arrow, who was the youngest economist to win the Nobel Prize. And he was in the weather service during World War II. And he wrote a report for his superiors and said, gee, we were forced to provide all these long range weather forecasts. And I've studied them and they're completely useless, right? Like you just take an almanac and use that instead. So you could dissolve our whole division and it would be better. And he got a response, a telegraph back from his commanding officer. And it said the commanding officer knows that the forecasts are worthless, but he needs them for planning purposes, which is such a wonderful line. And it resonates with me because I think a lot of the work a junior analyst does, and which I started my career doing, you're building these models, you're building these PowerPoint presentations, et cetera. And there's sort of you think you're trying to do the best job, make it the most accurate, but you don't realize that your commanding officers actually know the forecasts are worthless. If they're smart, they know the forecasts are worthless, but they need them for planning purposes. And you're engaged in producing these forecasts, which are basically a charade. Nobody believes them. Nobody's going to read it. Nobody's going to say, oh, what were we thinking in 2021? Let's pull out that old model and use it to, right? Like everybody knows that these things are out of date within 3 months because the future changes and you make so many mistakes. And yet there's so much effort, especially at the junior level, that goes into making these crazy things. And it was sort of a moment of disillusionment to realize, gee, none of these forecasts we're doing are accurate at all. And I think to sort of elaborate on that point, there's this wonderful study on the predictability, persistence and predictability of growth, which I talk a lot about in the book. And it shows that if you take, the last 3 or 5 years of revenue or earnings growth for a firm, it tells you actually nothing about future earnings or revenue growth. So you can say, okay, well, let's take the fastest growing firms or the slowest growing firms, and do they continue to be the fastest or the slowest into the future? And the answer is no. It's a coin flip, total coin flip. You can do the same with analyst estimates, take their forecasts and it's total coin flip. And that really, pushes you again in the direction of skepticism and adopting some knowledge of base rates and therefore a study of history, which is the only way you're going to get accurate base rates.
Absolutely. So, with that topic of trying to forecast earnings and revenues, so I think you touched on this with the shipping example, but like, why do you think it's so difficult to make those forecasts? Why do you think it's so hard to predict future earnings and revenue growth?
We look through a glass dimly. one of, you just separate out, stop thinking that you're an investor and just start thinking in everyday life. Seeing into the future is not a gift that humans possess, right? We've always had oracles and seers and prophets, but the average person really doesn't have much of an ability to predict things, right? And I often joke, I'm the world's leading expert in me, but could I tell you on a line by line basis what my net income, my bank account balance, and my asset value for all the things that I own is going to be in 2029, right? Like you'd say, well, that's like, well, of course not. Like, how would you have any idea, right? Like, that sounds crazy. And then you probably come to say, well, probably the best forecast is that that's going to be the same as it is today or something, right? Like you could get to sort of a base rate driven prediction, but the idea of sort of modeling it out, or that you wouldn't have some life event, you move to a new city, you get fired from your job, there's a recession, these things are inherently unpredictable, and all that makes life interesting is unpredictable. And so what I sort of am writing about in The Humble Investor is, can we find a way to profit from the fact that everyone else is trying to plan and everyone else thinks the world is too predictable, and make our investments something that will benefit from surprises and will maybe bet against other people's hubris? Is there a way to do that? And what are some of the methodologies? And of course, value investing is one of the classic ways in which you can bet on an unpredictable future and bet against hubris.
Yeah, absolutely. I'm curious, like on the spectrum of like why value works, are you more of like a on the behavioral side of the argument, or do you think it's like the Eugene Fama like risk-based explanation, or some combo of both? Like I'm curious what you
I think
think.
the risk-based explanation is silly. It's just trying to force not something that's observed in reality into a set of theories. I'm a believer in the behavioral view, perhaps, that essentially it's there, and there's a wonderful paper out of OSAM by the anonymous Jesse Livermore called Factors from Scratch, which is, in my view, probably the best treatment of this. But I think the reason that value investing works is that value stocks, the stocks that everyone's most pessimistic about, right? They think they're going to have terrible earnings or go out of business, or right, something horrible is going to happen to them. And then, and growth stocks, the glamour stocks are conversely the things people are most optimistic about. Nvidia is going to conquer the world, and pick your poison. Such and such, frac sand company is, doomed to a lifetime of terribleness because it's just a terrible company and a terrible industry, right? And what ends up happening is, because growth is unpredictable, a year later, Nvidia results haven't been quite as good as people thought, and the frac sand business hasn't been quite as bad. But that's only a minor impact. The big impact is that a year later, you make those same forecasts, and so much has changed that your forecast for the following year is totally scrambled relative to your forecast for this year. So the multiples change a lot. NVIDIA's multiples come down a lot. So the frac sand company's multiples go up a lot. And so you end up, even though NVIDIA did do better than the frac sand company over the short horizon, the multiples move so much to compensate because performance wasn't as good as expected. And that sort of process of forecasts being overconfident at the extremes and some level of just sort of randomness unfolding is, I think, what drives the persistence of a value effect. Which, of course, also brings us to the question of, well, why hasn't that happened in the United States over the past few years, right? Like, why has value defined, however you want to define it, not really worked? And the answer is that that process, whereby the things that people are most optimistic about, disappoint, just hasn't happened. In fact, the things that people have been most optimistic about have actually surprised to the upside. It would have been hard to be optimistic enough about NVIDIA or Microsoft or Facebook or Netflix, and almost at any point, especially the points where people got mildly less optimistic, were just amazing buying opportunities because the future has just unfolded in such a wonderful way for these companies, an exceptionally wonderful way, such as to be one of the most unique examples of corporate success in the history of the American stock market, right? Like we're talking about like the foundation of the railroads in like the 1920s. This is, one of the best periods for US equities as a result of and on the shoulders of some of the best corporate performances we've ever seen. These companies are in the top decile, and they're not only in the top decile, but they're big. And so that sort of set of historical circumstances meant that growth worked really well, and everybody was trying to find the next one of these. And so a lot of the sort of random thematic baskets tended to pop, and often a lot of them crashed too. But there was a lot of money that got made in the growth world of people chasing that type of company. And in contrast, value sort of mediocre, right? Like the companies didn't surprise that positively, but when they did, people still didn't care. You're like, oh, well, I thought the frac sand company was going to decline 5%, decline 3%, but it's still terrible, and I'd much rather own Amazon. And so the sort of wind got sucked out of the sails of any sort of value mean reversion. But I think this year we're starting to maybe see, either a false dawn or a broken clock is right twice a day, however you want to put it. But I think perhaps a paradigm shift where international value, which are these days international and value are synonymous, they're coming back, or they seem to be, and the generals seem to be stumbling.
Yeah, so that's an interesting topic to talk about right now. So after 15 years of US outperformance, you hear a lot of investors say, who needs international stocks in their portfolio? And then this year to date, international is actually doing tremendously in comparison to the US. So, anyway, so with that backdrop, what do you think is the key purpose of geographic diversification? Because I know you're a big proponent of it. Why is that important for investors?
Yeah. So first, there's sort of the efficient markets view, right? And that is that diversification is the only free lunch in investing. So if there are 5,000 stocks, tradable stocks, and I'm making up a number, why would you say, well, I'm only going to own the 2,500 in the US, right? Or why would you say, I think the 2,500 in the US are going to always perform better than the 2,500 outside of the US, right? Like it just doesn't, as a theory, like trying to justify that first principles, you just don't get very far. You're like, well, because the US is the best, or, like, well, and by the way, I'm a patriot. I think it is the best, but from a stock market perspective, I just think that's sort of a silly argument, right? And it's hard to sort of get there with any sort of empirical basis that one country should always outperform all other companies over every horizon. It just doesn't seem plausible. And it's not plausible, which is why you should also own the other 2,500. And then there's the question of, well, how much of the other 2,500 should you own? Should you own them in a weight that's relative to their market cap, which is sort of the EMH view, a weight relative to their share of profits, which might be a way that's going to tilt you towards value. I like a more aggressive tilt, maybe more in favor of the share of profits or the share of revenue, probably the share of profits or even the share of revenues. And that's going to take you from kind of 70% US to more like 50% US, which is a traumatic underweighting of the United States on a market cap weighted basis. But that's because international stocks are so much cheaper than United States stocks. And I think the other classic argument people use is I'm not getting any diversification for my international stocks, which is I think is such a silly argument because first, correlations between US and international have been dropping. So international is becoming more diversifying precisely because people have given up on international investing. So the flows are becoming more segregated. But also because when you think about diversification, right, like in some sense, like when the S&P is up 25 and international's up 10, right, like that's a very different performance, right? That's a diversifying outcome. It's not an outcome you liked if you're an international investor, but it's diversifying. And then this year, when the S&P is down and international's up 10%, right? Like that's diversified. These are very divergent outcomes. And you want things with, similar expected returns, but with very divergent outcomes are beneficial. You're going to get a smoother ride to the same place. And I think the problem is the US has done so well that they've been saying they're talking about diversification, but what they've really been talking about is relative performance. And of course, the US has had better relative performance, but that doesn't mean that's going to persist into the future.
Absolutely. And what would you say to someone who makes the argument that I don't need international stocks because US companies earn so much revenue abroad? Like, what would you say to that argument?
Yeah, so I did a really cool, to me, really cool, and probably to you, really cool, and we'll see
Yeah.
it to your audience whether it's cool or not. But I ran a regression where I took all the sort of style factors, value, quality, momentum, et cetera. You score all international stocks and US stocks on these style factors, and then you use those style factors to predict valuation, right? So a higher quality stock should have a higher valuation than a lower quality stock, et cetera, et cetera. And what you find, and then I added two variables. I added, is the stock listed in the US or not? So, is it a US listed stock? And then second, what's the share of revenue that's in the US? And what you find is the share of revenue that's in the US is not statistically significant, so it doesn't really matter. But the coefficient on that is actually negative. The higher the share of revenue you have in the US, the worse your valuation. And if you think about why that's true, right, like, companies like Google and Microsoft actually have a very large percentage of their revenue outside of the US. But the listing of the stock, controlling for all style factors, accounts for about 40% of the valuation difference between the US and the international markets. And so I look at that and say, well, that's silly. Why do I pay more just to have a listing in the US, right? If I can get a company like, P&G versus Unilever or something, or, Exxon versus Shell, why am I paying some massive premium to own the stock on a US exchange? When if I was willing to own a non-US listed company, I'd get a valuation discount for the same factor exposures. And so I think it's a twofold argument. It's one, well, there are a huge number of international stocks that have very large US exposures. Why are you excluding them for no reason? And then second, well, why are you paying a massive premium to own them in the US listing rather than abroad? It doesn't make sense.
Yeah, that does make sense. Do you think that international investing can help protect you from bubbles? So, I would think of an example of like a Japanese investor in the 80s. Some international exposure could have helped them avoid the collapse of that bubble. Like, do you think that international investing is a good way to basically avoid or minimize the impact of bubbles in your home country from impacting your savings?
Yeah, absolutely, right. And it's funny, international investing, right? If we were Canadians, thankfully we're not, but if we were Canadians, right, we'd be sitting here praising international diversification, right? Great. Like I'm so glad I'm an international investor. I put money in the US, right? Like and who's to say you're Canada versus the US for the next 10 years? Or Japan in the 80s, right? International diversifications work great for the Japanese, or you're an investor in London if we're English, right? And we're sitting in London. Thank God we did international diversification 10 years ago, right? So it's a very sort of US centric view of the world to even call it international investing. It's internet global diversification, which of course is going to reduce your risk and especially reduce your risk of getting a concentrated trade. And I talk a lot about my in my book about correlated beliefs and the risk of correlated beliefs, right? When everybody agrees on something, that's when the biggest dangers lie. And, the consensus around US being the only place you need to invest, you just don't hear that about any other country, right? Like nobody's being like, well, a lot of companies that are headquartered in Singapore get a lot of their revenue abroad. So like, why don't we only invest in Singapore, right? Like you just be like, well, that's crap. That's a crap argument, right? That's dumb. Or you'd say, well, Singapore is the best run country in the world. They're the best government, the smartest people at running it, and every other country is run by idiots. Could be a reasonable argument, but doesn't mean you should have all your money in Singapore. It just, right? Like none of these arguments actually make sense. Or if you say, well, we have the best run companies in the world, you're like, well, Switzerland has some really well run companies. Why don't you put all your money in Switzerland, right? It's just, these arguments just don't hold a lot of water when you apply them sort of, to other countries or you substitute them out. And I think that should show you that what there really are is justifications for history, right? Why has the U.S. outperformed? I'm going to give you a bunch of stories about why it's outperformed, none of which, by the way, tend to incorporate the fact the US dollar has just done really well and explains a pretty large percentage of the outperformance. And then I'm going to project that those stories are going to hold true in the future, which is sort of classic fallacy in the world of forecasting.
Absolutely. So going back to the value factor. So you're a huge believer in the value factor, as am I. Do you ever worry that the value factor could ever get arbitraged away?
Yeah. I don't because I think it's intrinsic to human nature to for there to be excesses of optimism and excesses of pessimism, and for people to be constantly trying to predict the future and then constantly surprised by their ability not to able to predict the future. And so I think of all the factors, value is the hardest to arbitrage away. But I think the way that you would look at it if it were to be arbitraged away, or if you were to measure the sort of value of value is the way that I think AQR came up with this, but the value spread, that take the cheapest 10% of stocks, the most expensive 10% of stocks, and what's the how big is the spread between them? And the bigger that spread is, the more, inefficient value is, or the bigger the value factor should be, and the smaller it is, the less efficacious it should be. And right now, we're near peak in terms of the value factor spread, right? Value is really, really, really attractive relative to growth in almost every market. By the way, same is true for size. Small caps are very attractive relative to large caps relative to history in terms of their value. There are other factors, the profitability factor, Robert Novi Marx's profitability factor, gross profit to assets. You could look at that and say, well, maybe that would be arbitraged away because, maybe people would just start to value quality better, but that factors actually work quite well. And I think I think if there's one sort of meta thinking that's underlying why a lot of these factors work or don't work, it really is this thing about predicting the future, that everybody's valuing stocks based on discounted cash flow models where they project future growth, and nobody can actually project future growth well. And so they're all wrong, and yet they're all doing it. And almost all of these different factors are ways of reflecting that same fundamental truth. So value is a way of reflecting that optimistic forecasts tend to be too optimistic and the pessimistic ones tend to be too pessimistic. Quality or profitability premium tends to be that, if you look at stocks that have high profitability, some are expensive and some are cheap. There's no direct, it's not price. It's a little bit price, but not much. Basically, people think, why would I care about this sort of stable return on asset metric? All I really care about is growth. And so they neglect the sort of boring ratio analysis in favor of the sexy growth analysis, not realizing that that ratio actually predicts at some level, the future financials better than their own predictions. And so, that's sort of or momentum is sort of a way of saying, well, stocks with high momentum, tend to be stocks where the short-term forecasts are improving or something like that. So that's sort of my sort of view of why these factors work.
Yeah, I agree. I think people will just continue to naively extrapolate whatever's happening. That seems to always be the case. So you also make a great point in the book about how value does best in crisis environments. So I thought that was very interesting. So why do you think value tends to deliver its best performance in crisis environments?
Yeah. Well, if you think about, trend extrapolation, right, as we've sort of been talking, extrapolate the recent past into the future. Think about being in the middle of a crisis. You're in, March 30th, 2020, or, March of 2009, and you're looking at all these stocks, and you've got a set of stocks where, revenue's down 50, profits are down 90, the stock's down 70 or 80%. And you look at that and you'd be like, holy smokes, the world's going to end for this company, right? Like revenues could go down another 50 and profits could go down another 90 and stock could go to zero, right? Like that's a very salient thing for you to imagine. And on the other side, a stock that's like revenues are down 10 and profits are down 20 and the stock's down 40 and it's beating the market by 10. You're sort of like, oh, they've made good decisions and they're going to emerge from the crisis stronger. And maybe that's something okay to hold. Or even crazier, let's find the beneficiaries, let's go buy the companies that are up when everything else is down. Let's go buy treasuries or something, right? And then what ends up happening, assuming the world comes back, right? And in the US, we've recovered from every recession. So, there's sort of a base rate of 100% probability of a US recovery happening. Well, what happens when the recovery happens is that company where, revenues were down 50 and profits were down 90, all of a sudden it goes back to being what it was before the crisis. And so revenues are up 100%. And then, profits are up 1,000% and the stock goes up like 10x, right? Just to get back to where it was before. And that's where the biggest profits are made. And the stuff that benefited or didn't do as badly also doesn't rebound as much because it didn't, it was less affected. So buying into these reversal stories and buying into the negative momentum and buying the stuff that's been most beaten up, you're also buying the stuff that has the highest chance of recovery. And you're buying it at a time when people's behavioral biases are most exacerbated, right? Where people are most likely to sell their losers and most likely to buy winners and most likely to do all the stupid things that people do, right? That happens during a crisis. Like your grandma isn't panicking, right now and saying, I should sell all my stocks. You got to get out of the market now, right? Like, unless your grandma really pays close attention or really hates Trump, then maybe she is. But, you look at like March of 2020, like very sophisticated investors are saying that, right? They're like running around there with chickens with their heads cut off, and like the Wall Street Journal is writing story, not that I don't want to pick on the journal, but newspapers are running stories like the Great Depression could be here, and go to gold, right? And these, just happens like animal spirits in reverse. And of course, those are the times when sort of systematic, disciplined, logical thinking has the greatest edge over the crowd.
Understood. And are the best returns earned emerging from the crisis? Like
Oh,
I'm
yes.
thinking like
I think it's something like 70 or 80% of the total returns in the value factor in the year following crises. relative to all other periods. I mean, it's just a massive concentration. The same with the size premium, interestingly enough, too. So small caps really, really do well coming out of crises. And then at other times, they're fine.
Yeah, you mentioned your own fund was up, I think, 85% from March 2020, like a year later. So it seems to me like if you were to miss out on that period of returns by trying to like time the factor, you would miss out on a bulk of the
Yeah,
returns from the
factor timing.
portfolio.
I think that you can time the value and size factor by buying more of them when high yield spreads are really wide, right? And so I think market timing sometimes gets a bad name because market timing tends to mean, selling every time you get skittish. But my view of market timing is there are times when certain asset classes or certain factors are more attractive relative to others. And those can be times to shift your assets, right, from one area to another. So crises are a great time to shift from safe assets to risky assets, and within risky assets to shift them to small cap and value. Whereas, good times are a time that, sometimes it profits to shift from risky assets to safer assets to prepare for a crisis or just to be prudent. And I think that those types of calculations, which take into account not only one's expected return forecast, but a sense of volatility and risk and reward, are very helpful ways of approaching the question of market timing. Because, like it or not, we're all market timers in some way or another, right? We're all shifting our allocations of stocks and bonds and shifting between different types of stocks, right? Every decision we're making is a timing decision as well as an investment decision, as much as we'd like to deny it.
So the high yield spread, so that's a super interesting concept. So for the audience, like what is the high yield spread and why do you think it is? You've shown in the book how it's effective at predicting these things. So
Yeah.
what is it and why is it a useful tool for predicting?
Yeah, the high yield spread measures the difference between the yields on risky high yield debt and treasuries, duration matched. And it's a wonderful, I'd say it's the best macroeconomic indicator, and you can test that in a whole variety of ways, and you'll come to the same conclusion I do that high yield spreads are beautiful, 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 predicting a wide range of different asset classes. But what you see is that spread, it's both it measures, how banks are thinking about bankruptcy rates, right? Like our investors are predicting bankruptcy rates, right? Because the spread goes wider when you expect more bankruptcies, and it's tighter when you expect fewer bankruptcies. It's very tight right now. Nobody thinks anything's going to go bankrupt ever again. And it also has real world effects. So when that spread goes wide, risky borrowers have a harder time refinancing and borrowing. So there's some level of self-fulfillment, right? Well, not a lot of things are going to go bankrupt when high yield spreads are below 300 basis points because anybody with, a pulse can refinance. But when spreads are at 800 over, gee, if you're not a pristine borrower, I'm sorry, but you're not accessing corporate credit markets, right? And so, of course, if you can't, if you need the money and you can't access corporate credit markets, you're going to go bankrupt, right? You don't have any other options. Versus now, when there's 17 private credit firms that'll give you a term sheet for whatever crappy thing that you've got. And I think that that's why the high yield spread ends up being such a wonderful, wonderful indicator, right? It's real time pricing of bankruptcy risk, and it has real world impact in the future and sort of self-fulfillment.
Awesome. So I wanted to get to private equity. So you're one of the most vocal critics of private equity. So you write in the book, private equity is the single biggest mistake investors are making in the markets. So why is that the case?
Yeah, so let's first start with what private equity is, because without knowing what private equity is, it's hard to see why it's such a mistake. And I'd say the first thing is that private equity buys companies that are very small, right? Median market cap would be 180 million, S&P is 30 billion plus, right? So you need a lot of you need a lot of private equity buyouts to add up to one large cap US stock, right? These are tiny little companies that are being purchased. And if we know one thing about small companies, it's that they're more risky and more prone to bankruptcy than large companies, right? They're less diversified, they have less scale, right? The downturn comes, they just have less of a margin of safety, right? So these are riskier companies. They're smaller and they're riskier. And when you think about sort of the aggregate size of the private equity market, the sort of aggregate profits of these businesses relative to the aggregate profits of public markets, maybe they have 2 to 4% of the aggregate profit of the entire market are in private equity type companies, right? So it's a really small, right? Small company, right? And private equity firms, they always have this marketing stuff where they're like, there are 10,000 small companies and only 500 large companies. So private equity is great. And, fine, but it takes a lot of dry cleaners to add up to a Facebook. So, who cares that there are, 10,000 small companies, right? Like what you want to know is how big is the profits, right? Like, where's the profit share? And that's disproportionately in the large companies, right? Just like it is in every other corner of markets, right? What's the wealth share? Well, the top 1% own 50% of the wealth. Well, the same power laws hold in markets, right? So that doesn't mean that all these small companies are adding up to much. And so you take this very small, very risky portion of the market, and maybe it's 2 to 4% of the market, and you make it 40% or 50% of your equity holdings, right? You're massively overweighting the smallest companies. And you should be aware that there's a lot of risk in doing so because smaller companies are riskier. But to make it even worse, these small companies are borrowing a lot of money, very historically high levels of debt, floating rate debt from private credit lenders now. And so they're levering these companies up to levels that are sort of obscene and would have been thought crazy 10 years ago. And so you've got this corner of the market where you've got tiny little companies that have a lot of debt, and then you say, well, are the valuations of this corner of the market right or fair or accurate? And first off, they're non-transparent, right? They're sort of marked quarterly, and the marks don't change, so that the reported volatility of private equity looks like that of corporate bonds. And gee, they're a lot more risky than corporate bonds. But even I think more scary than just the marks is thinking about like how much money has gone into this small asset class, right? You've not only had a massive expansion of equity as fundraising for these private equity vehicles has quadrupled in the past decade or whatever, tripled, quadrupled, right? So massively more money flowing into an illiquid corner of the market. And then private credit has risen up to provide massive incremental financing. So, you've just gotten a massive flood of money into this space. And so you have to think like, well, are the valuations likely to be inflated because there's been a massive flood of money into this portion of the market, which is very small, very liquid? And the obvious conclusion is yes. And so why would I, as an investor, massively overallocate to one of the riskiest, smallest corners of the market, where that small corner of the market has been flooded with capital, 3 or 4 or 5x as much capital as was available 10 years ago, and expect that I'm going to earn higher returns doing this sort of very consensus trade. And you add to that sort of the EMH view of the world where you're paying 2 and 20 fees on that stuff. And you think it's long only equities and I'm paying 2 and 20 fees, right? Like, would I pay 2 and 20 fees to, right, to own, a portfolio of micro caps? Probably not. Certainly wouldn't pay that to own the Russell 2000. So I think that that's got to be a drag in addition. And I think that that's why it's the biggest mistake, right? It's people flooding money into an area of the market that's very small, very illiquid, and expecting higher returns despite paying higher prices to own riskier stuff and paying higher fees to access it.
Absolutely. And I'm sure like the big reason that the money is flooding into it is obviously historical performance. So what is different about private equity 20, 30 years ago versus private equity today?
Yeah. The biggest difference is the valuations. There used to be a big valuation gap between small cap and large cap, between private markets and public markets. And so, there could be a publicly traded fertilizer company that traded at 8 times EBITDA, and you could buy a private fertilizer company for 4 times EBITDA, and you could borrow 3 times EBITDA to buy it. And then, you run it for a year, put some lipstick on the pig, and then you go to the public fertilizer company and say, hey, would you buy this for 6 times EBITDA? Look how accretive that would be to you. And they say, oh, great, 6 times is a deal. We trade at 8 times. And all of a sudden you've made some massive multiple of your money by executing this clever trade, right? You're being a source of accretive acquisitions to the public, company universe. Or you could even just build these things yourself and IPO them and get a valuation pop because scale businesses that were able to go public are, traded at a big premium to subscale businesses that could only be private. And there's a logic to that, right? Like you hear that, you're like, that makes sense, right? Like, accumulate a lot of these tiny, small companies at very low prices and put them together. And you've got a big company that can go public, and public companies are more liquid and trade at a premium. And now you've sort of got this reversal of this where the private markets trade at a premium to the public markets, which doesn't make sense. Why should I pay more money for a smaller, riskier, or less liquid thing than a big, less risky, more liquid thing that people do? And so I think the biggest change has been the valuations and the sort of simplicity of how money gets made, and probably the right sizing of capital, that probably there was too little capital chasing private markets deals in 1980s or 1990s. It just was sort of a frontier where there were only, a few very smart players going and doing it. And you had these people in Boston like TA and Summit who literally they'd get a bunch of like college lacrosse players and put them on phones and say, call every private company in the country and see if they want to sell. And, these competitive lacrosse players would find, four random companies in, Des Moines, Iowa that wanted to sell. And the guys would fly out there from Boston and offer to buy their, family business for some crazy low price and, sell it for 4x the money 3 years later and, rinse and repeat. And that was there were all these sort of great models that emerged because private markets were inefficient, but private markets ain't inefficient anymore, right? I mean, there are probably more investment bankers chasing private companies than there are private companies for sale, and more private equity firms chasing private deals than there are private deals to be had. And so there's just massive, massive competition.
So a lot of the investors in this, like they're sophisticated investors, they're pretty smart. So why are they still providing so much capital to private equity? Like, do you think that they're aware that the valuations are higher and that future returns might suck, and they're just willing to pay these fees to have the reported lower volatility, even though that isn't real? Like, why are they doing this, continue to do this in such a big way?
Well, the returns haven't been bad, right? So they were very good until the crisis. And then since the financial crisis, they've been sort of equal to equity markets. So there's no sort of return driven reason why this would have been a bad thing. So nobody's gotten fired for doing it. Point one. Point two, paradigms matter, right? Everyone wants to do, as an investment allocator, you're put, in trust of a large amount of money, right? You've kind of got to do something that looks like the industry standard, right? And something that's outside of the industry standard is going to be very risky for you from a career perspective, right? Like if you said, hey, there's a CIO of a college that put 40% of their portfolio in gold, right? Like everybody's going to sort of be like, well, who's that weirdo, right? Like, what the hell are they doing, right? That's going to get a lot of attention. And if it works, people are going to say, oh, the guys that got lucky on that gold trade. And if it doesn't work, they'll be that idiot, right? Like, so, and like for what gain, right? You're an endowment manager. You're not like earning carry on this stuff. So, why did you take that risk? You want to just do something that's broadly prudent. And so if everyone's doing private equity and every consultant is telling you have to put 20 to 30 to 40% of your money in private equity, why are you going to run against the herd and not do it? You're going to do it. You're just going to try to do the best job of it, right? And just try to do maybe more prudent than other people, but you're not just going to say, hey, screw this asset class. Because what's the justification for taking such an outsized bet relative to your peers, right? You have to benchmark against your peers. And I think that that's how you end up with, it just sort of being table stakes for large allocators to have to do private equity. Family, even large RIAs now sort of have to do private equity to kind of keep their clients happy because it's become sort of the industry standard approach.
Yeah, my favorite allocator is the guy that runs the Nevada Pension Fund.
Oh yeah, he's
That's
awesome.
mostly
Yeah.
he's got like a staff of two. We're going to invest in index funds and call it a day.
Yeah,
That
it's
seems
interesting. I sit on a church investment trust here in Boston, and it's funny. The last 2 or 3 years, we've been just top quartile performance, and one of the reasons for that is we don't own any private asset. No private equity, no private credit, nothing, and that stuff's actually not done that well for the last 2 or 3 years, and all the big endowments own it. So if you just didn't own private markets, you're looking like a hero right now. But over many years prior to that, the people that had a huge percentage of their money in venture capital, for example, looked like absolute kings. And if you didn't have VC, you were always like, well, you were up 12 and the median college endowment was up 14. And that's because median college endowment had 30% of their money in venture or something, right? And, I think as that story reverses, slowly the industry's benchmarks will change back again.
so. Another big argument that's made in favor of private equity is that these firms can go in and they can fix these companies, they can run them better, they can make them more efficient. Is there any truth to that idea?
I mean, not empirically, right? And not logically either, right? I mean, where did all these former investment bankers get so good at running companies? It's just not plausible on its face. And how does every private equity firm, like, how could you explain the entire asset class, right? Like, does everyone who go into private equity just run companies the same way? Like, well, what is that way? Like, what's their secret? What's the thing they all do? And if you look at it empirically, the thing they all do is they add debt to the balance sheet. So, right, like, and you can have a view on whether adding debt to the balance sheet is good or bad. They certainly, it's all they do it to every company. They don't increase margins at every company. They don't increase revenues at every company. There's no playbook. Obviously, certain private equity firms will say they have a proprietary playbook, but that could explain their idiosyncratic returns. But it's hard to see how that could explain the returns as a whole. And that also sort of is the presumption that all the companies they bought are somehow mismanaged. But these days, 40, 50% of private equity deals are sponsor to sponsor. So you're like, so KKR improved it, and then you improved it again, and then Blackstone improved it, then they sold it to CVC, who improved it again, right? Like, if it's sponsor to sponsor, like, shouldn't the improvement have been sort of wrung out like juice from an orange when the first private equity sponsor got it, right? It's just impossible to use that to explain the asset class's returns. And I think you can justify how your manager is better, but as an explanation for the asset class, it just doesn't hold any water.
All right. And then I know a big part of your research is also focused on how to replicate private equity returns in public markets. So what's the best way to do that?
Yeah, I think you just have to think about what the factor exposures are for private equity, right? And it's small, levered, and it used to be value. And so now it's small, levered growth. And I wouldn't recommend anyone replicate that factor exposure because it doesn't get you anywhere good. But the historical results of private equity when they did buy, dirt cheap micro caps with leverage were quite good. And I think there's quite a good logic behind investing in that way in public markets as well.
Awesome. And another provocative quote in the book that you have here that I liked was if high yield bonds were the OxyContin of private equity's debt binge, private credit is fentanyl. So why is private credit fentanyl?
Yeah, the availability of debt and the quantum of debt that can be provided to a small cap buyout is massively more today than it was 10 years ago. And the entire change is driven by the private credit industry, who have made private credit available to pretty much every private equity deal at crazily loose terms, massive multiples of adjusted EBITDA, with essentially no covenants and an endless ability to amend and pretend and extend and pretend. And the sort of implications for that are not good, right? Like, you give free debt to everybody and it ends up in a lot of bankruptcies, right? Look at student loans or look at mortgage-backed securities in 06 and 07, right? Massive debt binges don't end well because everybody goes bankrupt at the same time. And I think that that's what's happened with private credit. Like, at least the high yield bonds were publicly traded, and if they had to go find buyers, and if the bonds traded down, you could see it, and you wouldn't issue the same type of bonds. But private credit's totally opaque, totally marked to make believe. And their reported default rates are essentially zero, and their volatility is essentially zero. And all of that, I think, is adding huge amounts of risk to the system that people don't necessarily see.
Awesome. And then for my last question, so you have a great section in the book about asset allocation. So if someone wanted to construct a portfolio with a decent rate of return and lower volatility, what do you think are some of the key asset classes and strategies that they should incorporate into that sort of portfolio?
Yeah, I think within equities, you want exposure to the value factor and the quality factor, right? You want a mix of both of those things. I think value is best found in small caps, so I like small cap value. And quality is best found in large caps, so large cap quality. So I think a mix of small cap value and large cap quality of US and international, those are the essential equity building blocks. And then you need corporate credit. I know there are some people that don't like corporate credit, but historically the risk return profile has been quite good. US Treasuries as a safe haven asset. And you have to remember that treasuries are a safe haven asset only when inflation isn't the source of the risk. When inflation is the source of the risk, you need a different safe haven asset, which is gold. And so a healthy understanding of gold and its use in a portfolio is key. And I think, by the point that you've gotten corporate credit, gold, treasuries, and a mix of different factor profiles and equities, by the way, you need international diversification, you've got the major building blocks of a good asset allocation. And I think from there, you just have to think through your risk and return and what your return and volatility assumptions are, but you can use that to get to where you need to be.
Awesome. Well, thanks for coming on today. Do you have any parting words of wisdom for the audience?
I hope you'll go out and buy The Humble Investor. I highly recommend it. And if you're not following me on X, I'm at Verdad Cap, and we have a free weekly research email letter, which you can sign up for on my X profile as well. So thank you so much for having me on. This is a great conversation.
Awesome. Thanks for coming on. And for the audience, again, I highly recommend this book. You'll love it.
Thank you for listening to today's podcast. For more information, please go to securityanalysis.org. Subscribers to the website get early ad-free access to podcast episodes in addition to weekly in-depth profiles of companies.